let me just break down this this session title, Saving and Investing. There are different things involved with saving and investing, isn't there? Or savings and investments, which is savings is really, if you look at the way I've spent many, many years as a journalist talking to people around investing and then savings. And savings is kind of, key words come out like nest egg, capital preservation, making sure my money's safe. The word safe keeps coming through time and time again. Slow accumulation, ease of access. You look at all those catchwords. And then you look at an investment, and the different names come through investments. Some of the borrowed ideas, long-term, but people are more interested in about risk and opportunity. They understand, we hope, that with some opportunity comes some risk. And they mentally pigeonhole savings and investments rightly, because it's regulatory terms as well, in different areas. So let's start with the savings bit of the equation first. Now, in the savings bit of the equation, really what people care about with the savings bit of the equation is their capital's safe, they can get easy access to it, and that it grows a little bit over time. And I use that word little bit advisedly, because in a low interest rate environment, it's not going to grow a lot. No one's going to be able to change that, really. Would that be a good summation of the way in which people look at savings? Do people really look at savings and they just go, you know what I really care about here is capital preservation. I don't really care about the rest. Or am I being unfair?
Hi everyone, I'm Matt from Parity, which is actually now Tandem, so we've just been by Tandem. So I think it's a slightly more nuanced view than that.
Yeah.
So the way that we look at it really is kind of 4 steps really. One is actually just getting through to the end of the month. So even though that isn't savings per se, it's about putting aside the cash that you require for your particular bills. Yeah. The second is then that activation of just starting the behavior of saving. So let alone how much I'm going to earn on this. This is about just putting something aside, building some sort of safety net.
So that idea of frugalness, of just some diversion, just to keep some money away for
exactly. It's just that safety net. It's just that buffer against something that's unexpected. So if the first category is about the expected, is putting money aside for that. The second one, we think about it certainly as a plan, is kind of setting something aside for the unexpected. Then it's about kind of thinking a bit further ahead. What do I want longer term? Is it a holiday? Is it a car that I want to buy for? Often it's quite purchase orientated, or
so it's solutions orientated, or product quite often orientated.
Quite often, and then clearly we get into build my wealth, build my future type fourth category, which is where the kind of the overlap between savings and investment comes in. But I mean, for us at Parity and Tandem, we're particularly interested. Well, not particularly, but we're obviously looking at all the full spectrum of financial products, but those first 2 categories are really interesting because I think a lot of them aren't currently served as well.
So it's inducing behaviour change in which to do something regularly.
Completely, yeah.
Okay.
Yeah, and just to stick within the sort of the stages that he lined out, stage 3 and 4 is where I guess you could start to look towards investing, and I guess the problems evolve more and more in recent years, as you say, with a low interest environment.
Yeah.
ISA savings now, I think it's something like 75% of money still goes into cash ISAs.
Yeah.
So that's now becoming a problem. So companies like ours, Scalable Capital, we're now trying to help people in stage 3 and 4 with, first of all, are they suitable for investing to move from savings? So i.e., have they got the right nest egg, the right reserves, 3 to 6 months of cash savings set aside, and then what capacity for loss do they have if they are going to go into that 4th step and start building for their long-term wealth?
But let's just go back to the kind of behavioural tricks earlier on. You talk very eloquent, Simon, just about behavioural tricks, just to make sure that people begin to think a bit about putting money aside for a rainy day. What other things are out there that allow people to sort of get into the pattern of savings?
Well, I mean, in the pension space, people are automatically saving and investing, actually. So we don't see that much of a difference between saving and investing. And in fact, when you position something as saving, you find the consumer a lot more willing to part with their money because they perceive a lower level of risk. But
sorry, can I just pick you up on that interesting point? So you think, by and large, people regard pensions as savings?
Yes. Yes.
Very interesting. So I don't. I regard them as investment.
Oh, absolutely, because you know the difference between, low risk, high risk, medium risk, and whatnot. For most people who deal with pensions, most consumers, they've been automatically enrolled into a workplace pension. And so their first sort of encounter with the pension is seeing some money going out of their payslip, and them being told, it's going into a pension. They have kind of, a limited view of what happens next in terms of There's a pension provider who takes it, they invest it in a default fund. That default fund is generally predominantly equities based. So will consist of around 60 to 80%, global shares if they're in a good default fund. And for most people, therefore, it's just money that they're putting aside. So, and it's saving. They don't necessarily perceive the risk that comes with it until slightly later on when they start to get a bit more engaged and pay attention. But it does seem like this automatic way of getting people to put money aside without focusing them too much on the risk that they're taking, especially because it's a long-term investment and they should be willing to bear risk, is a good way to kind of get over that psychological barrier of, oh, my money is going somewhere else.
But surely, Joe, just a nitpicking, but if they put it in a pension, they can't get their money out until they retire.
No, absolutely.
So it's not savings in any stretch of the imagination. Is it savings?
It is savings. I mean, it depends on how you define it's savings for retirement.
Okay. You can effectively do nudge and auto enrolment, which is a form of nudge at the moment with the new auto enrolment scheme coming up. Are there any other kind of behavioural techniques that you guys have generally worked on that allows investors to get more used to the idea of savings and investing?
Well, something that's slightly different.
I think yours isn't on.
Okay, getting used to that. We're in insurance, and insurance is viewed by some consumers as investing. It's actually,
really?
Pretty much the opposite. But people, putting significant amounts of their money into insurance every year and expecting some kind of return. The best return on insurance is no return. And what we see is dramatic overspend. So consumers spending billions every year that they don't need to be because they're not actually engaging with their insurance. That's one of the issues that we're...
I'm about to say, because one of the issues I've always found in insurance, and I'm as guilty as the next person is that we don't monitor our insurance. I don't make an effort of looking at my investments every day. I've stopped doing that because it's a very bad idea and encourages very bad behavioural practices. But I do look at my investments every week or month, yeah. But I probably don't look at my insurance about once a year, probably when renewal comes up. I don't bother monitoring at all, except when I go onto an insurance comparison site and they go, bloody hell, I could save a load of money. Do people closely monitor their products like insurance products?
No, absolutely not. People know that their premiums go up every year. After 5 years, people pay about 75% more than a new customer. So it goes up
75%?
75% more. That's what the FCA found and introduced various different things to encourage insurers to put the premiums on the renewal documents, but consumers still don't switch. So, 2/3 of people will switch very rarely, despite knowing that they can save.
Remy, I said both of you actually. Do people monitor their pensions that carefully?
Well, I think our customers do. So
I think you might have trained them a bit
better. So the average person at Pension B logs in around 4 times a month to check.
4 times a month?
4 times a month just to check what's going on. And I see Simon nodding his head, meaning it's probably similar at Scalable.
4 times a month?
Yeah, it starts at daily and then
really
levels out around 4 times.
Yeah, so we see something similar. So they are definitely looking at it, and I think that you as a business have a decision to make of how often do you want them looking at it. We personally have decided that the more engagement, the better.
Right. Okay.
Even when stock markets are challenging and bumpy.
Sorry, go on.
No. So we've had quite a lot of experience in what we call the activation space. So, I'm fascinated by this whole space because this is behavioural economics.
I was about to say, exactly.
The psychology of saving is the most complex, nuanced topic in the world.
Yeah.
Because people tell you one thing, people tell you what they want, they do completely the opposite. It's a fascinating topic. But essentially, we did a pilot last year with HSBC at Parity, and we were trying to solve exactly this, which was how do you get people to and take that first step, that first initial action. So we did tons of interviews around why are you saving, why are you not saving, why are you struggling to save, and it's almost an offensive question when you say to the vast majority of people, why aren't you saving? How much can you save? Because I spend so much time working and I spend everything I earn. I spend everything I earn to get to the end of the month. How dare you almost ask me about why I can't save 10, 20, £50 a month? And, the more that we dug underneath this, we kind of discovered a really interesting thing, that basically there's this relationship between spending and saving, of spending being the enemy of saving. So, kind of a big thing that we were looking at was the extent to which you need to control your spending versus the amount that you need to start kind of thinking about and planning ahead for your savings. And typically people, they have a couple of different strategies when they're saving. So historically, they either save first or save last is the way that we described it, which was, at the beginning of the month, you have a look at how much you've earned, you've had a look at your bills, and you go, I think I can save £50. So they stick it away in another account, stick £50, stick £100 away. By the end of the month, spending comes in, you overspend, something got in the way, and then you're clawing all of that £50 that you set aside back. The flip reverse of that is this save later approach, which is, okay, right, I'm not going to put any money at the beginning of the month, but at the end of the month, if I have anything left over, I'm going to stick that into a savings account. Spending is the enemy then, again, because actually you come to the end of the month, there's nothing there to put aside. So that relationship is a fascinating one because the intent is there. People know that they really want to. But as I say, that spending is the enemy of saving. So what we found really is how can you play some kind of, I don't want to say tricks, but what sort of behavioral nudges, what sort of kind of incentives can you give? And we tried a bunch of different ways of trying to get people to automatically save, some consciously, subconsciously. And we ran 4 rules just as a pure test with HSBC customers. One was linking spending to saving. So it was every single time that you spend in, let's say, take an Uber or go to McDonald's or whatever you want to do, put £1 aside. So trying to kind of link the behavior that you didn't want to do with the positive reinforcing behavior of what you did want to do. Hugely effective.
Hugely effective.
Second one was rounding up your spare change to the nearest pound. That's quite a common model that we've seen in the UK. Hugely effective, again, because actually people don't really miss the last 20 pence of a transaction. And then at the end of the month, you come and you've got 30, 40 pounds that you didn't realise you had. Phenomenally effective. And then the final one is just us doing it for them. So us kind of analysing your upcoming bills, analysing your spending, and us saying, hey, we've put £7 aside because actually it looks like you could afford it. The most effective of all of them.
Most effective of all.
So actually, I think it's such an interesting topic.
Can I just pick, what about, I've heard, this is particularly relevant for pensions and investment, but it could be true for lots of other things, where people have sort of do automatic escalator models.
I was just about to mention automatic escalation. I think one of the issues with rounding up change is that it's very difficult to amass a meaningful amount, and then once you do, people are suddenly surprised by it and want to withdraw it and spend it. So I think the key is really to try and find ways to lock people into good decisions for long periods of time without them necessarily noticing. So some of the research that's been done in the US is that if you get people to start off with small contributions, but encourage them to increase them really easily after a certain period of time, let's say by 2%, after a year, and then 2% again after that, and then 2% after that. Maybe we can argue about whether 2% is right or not. But if you encourage them to commit upfront and do that, they kind of forget that it's happening. And the effectiveness of saving ends up being much, much better.
Simon, I just want to turn it right back around for a long term, because a lot of our stuff has been focused on the short term, about this month, next week, next day. Just go back sort of 30, 40 years, I've always been struck by the amount of people who've done, a lot of the banks have done work on this, about how much you need to be able to successfully retire. You get to the age of 65, or when we get there, we'll be 85. So you get to the age of 65, you retire, and you work backwards as to what percentage of your income you need to be putting aside. And by and large, I was brought up by a particularly kind of Presbyterian family who basically insisted, I said, 20% of all your income should be put aside. That was drilled into me. And yet, survey after survey has found out that people don't do that. They just don't have any long-term conception of that's the pot of money I need, and therefore work backwards via compounding principles. I need to be putting aside X. Is it as bad as I think it is?
Yes, it is, but it's getting better.
It's getting better. Okay.
And kind of to pick up on a point you said to
yeah.
me, sort of how often do you want people engaging with their investments and things? Well, kind of that's one of the answers why you want it as frequent as possible.
Okay.
The opportunity we have to educate and handhold a client once they've got it, whether it's an investment or their current account, doesn't matter what it is, that opportunity is where you can make a difference by showing them, whether it's graphically or whether it's through blog articles or...
Because I must admit, a lot of the robo platforms are very good, apologies for using the robo platform, but Digital Wealth Platform was very good at using those charts, and I think that's one area where you've really revolutionised stuff generically. All of you are good at that. Because that does help graphically.
Yeah, precisely, because it's very hard to know how much money do you need at retirement.
Exactly.
The stat we always give out, or often give out to clients, is to have a £50,000 income today, age 65, with current annuity rates, etc. You need £800,000 in your account. Yeah. So it's,
I just want to pick up one point that Matthew mentioned. Might machines actually be better? Because what I mean by that is that effectively your last option was that somebody, which could be a machine, fundamentally decides that you should save this amount of money, which is a logical premise. As we go down the track, we're going to have AI introduced into systems, and it's going to look at your overall financial savings, and we're going to have a program that's just going to turn around and go, you know, David, you're just not saving enough. You need to be doing 50 quid a month, and if you don't, I'm going to keep annoying you every time you go and do it. But what that opens up is the question whether or not AI and machine learning is just going to be a much more effective way than doing things in individual volition.
Partly. I think clearly kind of algorithmic automated investing has a huge role in the activation space as much as anything. I mean, as you were saying, kind of small little amounts are all well and good to get you going, but then actually, well, how do you build up from there? So I think that's great for just helping people who didn't even realize that they could save, or helping people give them that nudge to get going. But ultimately, to build a long-term sustainable savings plan, you need buy-in, you need kind of an emotional connection in. So I think actually it's about how you turn that activation point of getting people saving into then getting them bought into how can I increase that? How can I kind of grow it over time?
Yeah, I mean, I think the key issue with machines is trusting a machine to make the right decision for you.
But I question that. I think a lot of people probably will end up, because my instinct is that a lot of people don't actually trust their own internal abilities to do with money. They're frightened of it for lots of reasons, and they're worried about it, and they feel put upon by the financial elite telling them that you should do this, and they go, really, I don't want to do it. I actually think people will trust the machines.
Well, I think there's a right way to do it.
Yeah.
So if you give people upfront transparency in terms of the recommendation and give them control over changing the outcome of the recommendation, then it's a bit like auto-enrollment. They have the option to opt out, but actually only around 10% of them do opt out. So giving them the ability to change their minds, just having that is really important. And then I think, again, you probably want to start off with small amounts so people don't, think it's very meaningful when they get an app notification that says, your robot has suggested you save £2 this week. That the next time it comes like, it's £20 this month. Oh, it's £100 next month. Having that, level of increasing trust, I think is the right way to do it, to make it more human in a way.
And I just want to repeat, actually, when it comes to insurance, I don't think people will care. I think actually, in the nicest possible way, that if I got an AI program that told me that I've got all of these things and I could save 70 quid, 700 quid, I'd be like, press that button.
Yeah, we think machines have a huge role to play in helping people to delegate the decision-making process that they're not actively engaging in themselves.
Because they're not emotionally engaged to insurance as the same way they're as a pension. In the nicest possible way, I don't really care as much about my insurance provider as I care my pension provider's still around.
We think that it's definitely relevant in insurance, but I think it's relevant in other areas as well, where machines are designed to make certain decisions. They're programmatically, that's what they're good at. With defined inputs and goals, a machine can make a better decision than a human. We're seeing that in so many different domains now. So, doing that in areas where consumers are just actively not, making rational decisions. I mean, when you look at it in its purest form, people are making irrational decisions. So, help using machines, for the purpose of bettering people's financial positions is very aligned with what they're supposed to be doing.
Quick last couple of questions. Talk about emotional engagement. People do like getting emotionally engaged, and they like things that are shiny, new, and sexy. We've been taught that by behavioural economics time and time again. It's a good question here. Do investors see cryptocurrencies and tokens as potentially a way of engaging people? Now, obviously, you wouldn't want to be doing that for savings, let's be brutally honest. It'd be a very volatile savings scheme. But what it does actually flag is that people like emotional engagement. They like getting a bit excited about stuff, and cryptos is a very good way of getting, engaging a certain segment of the market to get excited about it. Are you going to think about it as scalable?
People get excited about it because people like gambling.
Yeah, exactly.
It's not something you can get involved with as a robo-advisor, because you'd never get through the suitability element.
No, you never get through
in terms of the risk levels.
No, but also from an ethical standpoint, I just think, allowing people to put their savings into something that can go to zero is just not the right thing to do. There's other ways of getting people engaged, though, that are more emotional. So we recently introduced an ethical option at Pension B, which allows you to invest your money in more kind of eco-friendly stocks. So with the lean towards kind of carbon-friendly companies, and we find that around 15 to 20% of people pick that option, and then we find that they do tend to contribute more. They do tend to check in on what's happening, and they want to know where their money actually is, all of which are very positive signs of engagement.
One other last question. This actually touches on one of my own pet bugbears. Do platforms track performance against cash ISAs and cash savings? Do consumers accept cash as not a great source of value? Which actually does raise an interesting question, which is tracking the performance of things is horribly important, actually. And one of my favourite bugbears is that although the robo-platforms are very good, by and large, most platforms are rubbish at tracking investments, against certain delegated targets. They're great at looking at the shares, for instance, in them, but against targets. And again, with insurance platforms are absolutely rubbish at telling you what your last insurance rate was until they're forced to. I think, by the government, weren't they? How does my insurance compare with last year's? This element of comparison, of seeing stuff, that's one area where you can do a huge amount of work, can't you?
Yeah, and I don't think it's also just tracking the financial product in its own right. So, if you think about the journey that somebody goes through when buying a house, there's so many different moving parts there. There's the delta between the cash that I've got currently in my savings account and the deposit that I require, and clearly, like the interest rate that I'm getting in the meantime. There's also the house price growth at the same time as well. So, at Tandem, something we're increasingly thinking about and kind of looking at is how you align people around these concept of life events. So, there's multiple touch points. There's multiple financial products. Some of those are short term, some of those are long term. So how can you engage with people early, for instance, to get them thinking about buying a house potentially in 4 years' time, but get them thinking about now? How much do I need to put aside now to build that house deposit, for instance?
Can I just a really good question here. Saving can feel, apologies for you guys that you having to stick your neck around there. Saving can feel demotivating as people lose money to spend today, and should they dip into savings, they might have to start again. How would you solve this? You sort of already raised this question. It can be very demotivating. So what are the kind of mental shortcuts that can start to get them saving again?
Yeah, so I think this is exactly where some of kind of the automated algorithmic stuff comes in, which is, just setting it aside without people even noticing. Actually, it's an incredibly nice, surprising, fulfilling thing to see that at the end of the month, there's even 30 quid that felt like it was never in my account in the first place has just magically kind of popped out. So I think there's some really nice behavioural plays that you can do to kind of how you can identify the cash that people have during the month, set that aside, but also how you make people feel good about that journey. Because the problem with savings is it's delayed gratification.
Yeah.
I get a ton of gratification going and buying a coffee in Starbucks. How can I make that feel as good by putting aside even just £1 or £2 on a daily basis? So I think I hate the phrase gamification. I think there's nice kind of rewarding types of gamification that you can do to get people along the journey, but also, as I say, a lot of the automated stuff as well can just make people feel good without them even realizing that they're saving as well.
I think it's about keeping people in the market too. So lately we've had a lot of kind of volatility and pension balances going up and down in the short term. But if you keep people invested long enough, eventually it does go back up. And if you show them the gap between what they put in and what it's actually worth, I think at that point they also start to learn and to feel more educated around how does it actually work, and therefore to feel more rewarded and much more likely to go for that longer term gain at the expense of the short term.
That just raised a very quick question I just wanted to ask all of you actually. Financial journalists are very jaded, so we're used to the stock markets going up and down. In fact, we like it when it goes down because there's more for us to write about. But we get used to it, so we're just like, stock markets go up and down. That's just the way of things. So when the stock market did have a little bit of a tumble in the last couple of months, did you get a big number of telephone calls, people ringing in and saying, what's going on?
Yes.
Quite a lot.
Yeah, well, I mean, enough that we noticed.
Okay,
and interestingly, it was for relatively new savers, so people who had actually smaller balances than
so it's the smaller balances.
Yeah. And they called to ask, where's my £20? Literally. And for us, that was quite a flag around there is a lack of kind of knowledge and experience, because people have come out of these auto-enrollment schemes. They've just never seen it happen. But once they see it a few times, I think that they start to recognize that it's normal and perhaps that it creates an opportunity.
Presumably, but Scalable, you tend to have minimum 10,000 anyway, so you have a slightly different class of customer in the nicest possible respect. But did you even have people ringing up and saying, what the hell is happening?
So I think probably the financial journalists reacted more than the clients, to be honest. Clients as well, but I think we try to be proactive about the way we kind of dealt with that whole situation. You know, we panicked a lot in the office. Okay, we need to get in early on Monday, all hands on deck.
I was wondering.
We need to get a newsletter out first thing to make sure that everyone's comfortable that in reality all we were seeing was a more normal level of risk returning to the markets. You know, the fluctuations that we've seen over the last 18 months are way below average.
Yeah, exactly.
What we're seeing now, okay, yes, it's a negative trend over the last few weeks, but it's much more normal. And helping people to understand the context of their investments and the fluctuations kind of really helps them to have some ease. And I think on the final thing, you know, on trust building, if you go through a period of negative performance, handhold people a little bit, explain what you are doing or what you aren't doing with their portfolio allocations, etc. When you come out the other end of that, that's when you've got a really strong relationship and you can really help the client.
Just quickly.
Yeah, and it's about the right financial product for the right person, right? Because if you've only got £50 to the end of the month, you're putting it in an investment ISA.
You're not going to be an investment.
You know, it's
the stock market's not a very good idea for you if you've got that.
Product,
Okay, well, look, we've run out of time. Put your hands together. Thank you very much to this panel. Excellent panel. Thank you.